The stock market is not the economy. Here's why. Stock prices are rising. Headlines say the economy is strong, but something feels off. Inflation is high. Wages are tight. Housing is expensive. Debt is rising. So, how can the stock market be booming while people feel squeezed? Because the stock market is not the economy and never has been. Let's break this down. First, understand what the stock market actually measures. It does not measure how people are doing. It measures the expected future profits of publicly traded companies. That's it. Not wages. Not small businesses. Not employment quality. Not cost of living. Just corporate earnings. Now, here's the first major disconnect. Most companies in the stock market are large, multinational corporations. They earn revenue globally. If the U.S. consumer slows down, but overseas markets grow, profits can still rise. The stock market reflects global corporate strength, not local household stress. Second disconnect. The stock market is forward-looking. The economy is backward-looking. Economic data tells us what already happened. GDP, unemployment, inflation. These are reports about the past. Stock prices reflect expectations about the future. If investors believe conditions will improve next year, stocks can rise today, even if current data looks weak. Markets move on expectations, not current pain. Third disconnect. Ownership. Roughly 10% of households own the majority of stocks. That means when the market rises, the wealth effect is concentrated. The average worker does not feel stock gains the same way asset holders do. So headlines say, markets hit new highs. But many people feel no improvement because asset inflation is not wage growth. Fourth factor. Liquidity. When central banks lower interest rates or inject liquidity into the financial system, asset prices rise. Why? Because lower rates increase the present value of future profits. Money becomes cheaper. Investors search for yield. Capital flows into stocks, even if the real economy is slowing. This is why markets can rally during weak economic periods. Liquidity drives asset prices, not just economic strength. Now let's talk about corporate efficiency. During economic slowdowns, companies cut costs. Layoffs, automation, efficiency drives. Those actions hurt workers, but they can increase profit margins. So, paradoxically, bad news for employees can be good news for stock prices. The stock market rewards profit growth, not employment stability. There's another layer. Market concentration. A small number of large companies now make up a significant portion of total index performance. If a handful of technology giants perform well, they can pull the entire index higher, even if most companies are struggling. So the headline says, the market is strong. But under the surface, breadth may be weak. Let's make it simple. The economy measures production, employment, income, spending. The stock market measures expected corporate profits. Those are related, but they are not the same. Here's a historical example. In 2020, the economy shut down. Unemployment surged. GDP contracted sharply. Yet the stock market recovered rapidly. Why? Because investors anticipated massive stimulus, low interest rates, and future earnings growth. Markets move ahead of reality. The economy catches up later. So when you hear, stocks are up, so everything must be fine, that's an oversimplification. Asset markets reflect liquidity, profit expectations, capital concentration, future forecasts. The economy reflects current lived experience. They intersect, but they are not identical. Now, here's the important takeaway. If you judge economic health purely by stock prices, you miss the bigger picture. And if you ignore the stock market entirely, you miss where capital is flowing. Understanding the difference helps you avoid emotional reactions, because rising markets do not always mean prosperity, and falling markets do not always mean collapse. The stock market is a forward-looking pricing machine. The economy is a real-world system of production and income. One moves on expectation, The other moves on reality. Confusing the two creates misunderstanding. Separating them creates clarity. Signal over noise. If you want structured breakdowns on markets, macro forces, and the systems behind the headlines, subscribe, because the difference between signal and noise is understanding how things actually work.